Purchasing inventory is an essential part of running a merchandising business, but not every shipment arrives exactly as expected. Merchandise may be damaged or in transit, defective, the wrong size or color, or simply fail to meet the buyer's specifications. When these situations occur, businesses have two primary options. They can return the merchandise to the supplier or negotiate a reduction in the purchase price while keeping the goods. These transactions are known as purchase returns and purchase allowances. In this video, we'll examine how businesses account for purchase returns and allowances under the periodic inventory system and see how these transactions affect inventory, accounts payable, and the financial statements. When businesses purchase merchandise for resale, they may also return merchandise, receive allowances, earn purchase discounts, or pay freight charges to have goods delivered. To keep these transactions organized, accounts use several different accounts, each designed to capture a specific type of inventory-related cost or reduction. The purchases account and freight-in account increase the cost of inventory acquired during the period and therefore have normal debit balances. In contrast, purchase returns and allowances and purchase discounts reduce the cost of purchases and are classified as contra accounts with normal credit balances. Now, trade discounts are handled differently. Rather than recording them in a separate account, the discount simply reduces the purchase price of the merchandise, and as a result, only the discounted amount is recorded. Together, these accounts help accountants determine the true cost of merchandise purchased during the accounting period. And ultimately, accountants incorporate these accounts into the calculation of cost of goods sold, which appears on the income statement and represents the actual cost of the inventory sold to customers. In the previous video, we focused on the purchases and freight-in accounts. In this video, we'll focus on the accounts that reduce the cost of purchases, purchase returns and allowances, and purchase discounts. Let's examine each in more detail now. When merchandise arrives, it is inspected to verify that the correct products were received and that they're in acceptable condition. Occasionally, however, goods may be damaged, defective, or different from what was ordered. A purchase return occurs when the buyer sends the merchandise back to the supplier. In response, the supplier issues a credit memorandum, which reduces the amount the purchaser owes. A purchase allowance occurs when the purchaser keeps the merchandise but receives a reduction in the purchase price because the goods are damaged, defective, or otherwise unsatisfactory. Just as with the purchase return, the supplier issues a credit memorandum to document the reduction. Both the purchase returns and purchase allowances are recorded in the purchases returns and allowances account rather than the purchases account. This account provides a complete record of all purchase reductions and helps management identify potential issues with suppliers, product quality, or shipping practices. Purchases, returns, and allowances is a contra account that reduces the cost of purchases. While purchase-related accounts normally have a debit balance, the purchases, returns, and allowances account has a normal credit balance. It is important not to confuse purchases, returns, and allowances with discounts. A trade discount is a reduction in the selling price offered by the supplier, often based on the quantity purchased or customer type. For example, a supplier may charge $20 per unit for orders under 10 units, $18 per unit for orders between 10 and 20 units, and $16 per unit for orders over 20 units. Some suppliers also offer wholesale discounts to all business customers. Trade discounts are not recorded separately in the accounting records. Now, instead, the discounted price is simply used when recording the purchase. Now, a purchase discount, on the other hand, is a reduction in the amount owed because the purchaser pays the invoice early. For example, terms of 2-10 net 30 means the buyer can deduct 2% from the invoice amount, if payment is made within 10 days. If payment is not made within the discount period, the full amount is due within 30 days. Here's an example of how Max Out Sporting Goods records purchases, returns, and allowances. Max Out Sporting Goods received merchandise costing $4,760 from Modern Sportsman on January 15th, invoice 1100, with freight charges of $360 paid by Modern Sportsman and added to the invoice. In my prior video, we recorded this purchase with a debit to purchases for $4,760, a debit to freight in for $360, and a credit of $5,120 to accounts payable. Now, unfortunately, some goods were damaged and the supplier granted a $476 purchase allowance on its credit memo 103 of January 27th. When we analyze the transaction, we find that accounts payable decreased because of the purchase allowance. Accounts payable are a liability, and liabilities decrease with debits. Max Out Sporting Goods also has more purchase returns and allowances, which is a contra expense account, which increases with credits. So we debit accounts payable and credit purchase returns and allowances. We prepare the journal entry by entering the date into the date columns, write accounts payable into the description column, and $476 into the debit column. On the next line, we write purchases, returns, and allowances, and a credit of $476. Now, when Max Out Sporting Goods pays Modern Sportsman, we debit accounts payable for $4,644 and credit cash for the amount of the original invoice of $5,120 less the credit memo of $476 or $4,644. Here's an example of a purchase discount or early payment discount. Max Out Sporting Goods received merchandise costing $3,000 from Modern Sportsman on January 10th, invoice 880, with terms of 2% for 10 days or net 30 days with freight charges of $200 paid by Modern Sportsman and added to the invoice. We analyze the purchase transaction and find that the business now has more purchases, which is an expense account, and that expense accounts increase with debits. That means we need to debit purchases. Max Out also has more freight in charges, which is an expense account and increases with debits, so debit to freight in. Accounts payable also increased, which is a liability account, and liability accounts increase with credits. That means we need to credit accounts payable. We record the purchase by writing January 10th into the date columns, purchases into the description column, and a debit of $3,000 into the debit column. On the second line, we debit freight in for $200, and on the third line, we slightly indent and credit accounts payable for $3,200. On January 19th, within the 10 days time period for taking the 2% purchase discount, Max Out pays the invoice due with check 150, and we need to determine how much is due to Modern Sportsman. First, it's important to remember that the 2% purchase discount is calculated excluding the freight. So in this case, $3,000 times 2%, which is $60, and the amount due is $3,140, which is $3,000 minus 2%, or $2,940 plus $200 freight, for a total of $3,140. Next, we analyze the transaction and find that the business now has less accounts payable, which is a liability, which decreases with debits, so we debit accounts payable. Purchase discounts are increased because the business is taking the purchase discounts within the 10-day time period, and purchase discounts are contra expense accounts, which increase with credits, so we credit purchases discounts. The business now also has less cash. Cash is an asset, and assets decrease with credits, so that means that we need to credit cash. To record the transaction in the general journal, we debit accounts payable for the full amount of the original invoice of $3,200. Credit purchases discounts for $60 and credit cash for the payment of $3,140. Purchase returns and allowances help ensure that a company's accounting records reflect the actual cost of the inventory it intends to sell. Whether merchandise is returned to the supplier or a price adjustment is granted, accounts must record these transactions accurately to maintain reliable inventory and accounts payable balances. In the next video, we'll shift our attention to the accounts payable subsidiary ledger and see how businesses track amounts owed to individual suppliers while maintaining control over the overall accounts payable balance reported in the general ledger.